You ever hear about a stock that's either making people rich or making them bite their nails? That's Nvidia. It just dropped over 2% today, wasn't everyone's watching. But hold on, this isn't just about a red chart. This is about the company that's powering AI, gaming, data centers, basically the brain behind the future. Let's take a step back and see what's really going on under the hood. Yeah, okay, so look, past week and month, Nvidia's been a bit flat. Down just a few percent, nothing dramatic. Kind of feels like it ran hard, and now it's just taking a breather. But if you step back past 6 months, a year, it's been on fire. Like, seriously. Up 55% over the last year, over 40% in just half a year. That's not normal, man. That's a stock that's been riding a real wave. And then if you go back further, 2, 3, 5 years, it's straight up crazy. Over $1, 200% growth in 5 years. I mean, that's not just good stock growth, that's life-changing growth. It went from graphics cards for gamers to being the backbone of AI and data centers. Like, it's the hardware behind the hype. And what's funny is it's not even that volatile day to day. It doesn't jump around like some wild meme stock. It moves, yeah, but more like a confident heavyweight. Not frantic, just strong. And compared to the S&P, it's been crushing it. While the whole market does 10%, Nvidia does 5 times that. So yeah, short term it's cooling off. But the bigger picture, that's where things start to get interesting. So you know how some stocks kind of have a rhythm, like certain months they just do better year after year? Nvidia's got that vibe too, and this table shows exactly that. Now get this, May is the superstar. On average, it's up like 19%. And this year, even better, 24.1%. That's huge. It's like every spring, this thing wakes up and goes, all right, time to run. February and November are also pretty strong. February usually gives you double-digit gains. This year, not as crazy, but still plus with 4%. And November, solid. Not just in the data, but also one of the calmer months in terms of volatility. Low stress, good upside. Love that. But man, January and March this year, brutal. Normally they're decent months, like plus 6% on average. But in 2025, they tanked. March dropped 13.2%. January was down 10.6%. That's not just bad day at the office, that's full on don't check your portfolio mode. Maybe it was just the market cooling off after a hot year. Now check this. December, surprisingly weak. I mean, most stocks do well at the end of the year, Santa rally and all that, but for Nvidia, on average, 5.2%. Looks like people are cashing out gains or something. And September, yeah, not a fan favorite either. It's actually the worst month on this list. AVE drop of 8.3%, and even this year it stayed red, 4.1%. Volatility-wise, it's kind of funny. January's the wildest. Swings all over the place. September is weirdly calm, but still tends to slide. So yeah, it's not about trying to guess the perfect entry, but if you're tracking patterns, Nvidia definitely has its moods. Spring and early summer, historically strong. Year-end, meh, but hey. Past performance is just that. Doesn't mean the same thing happens next time. It's just interesting to see how the stock tends to behave, like getting to know its personality a little better. So this is a list of analyst opinions on Nvidia, basically what the Wall Street crowd thinks. And man, it's almost a clean sweep. Look at that. Out of 30 analysts, 26 said buy, only one said hold, and just one said sell. That's rare, like really rare. It's not often you see that kind of consensus, especially on a stock that's already been flying. Feels like everyone and their intern is bullish on this thing right now. What's even more interesting? The dates. Most of these ratings came in at the end of August, which means it's not stale info. These are fresh takes, and they're all pointing in the same direction. So this isn't leftover hype from 6 months ago. It's what they're saying right now after earnings, after all the AI buzz, after the dust has settled. You've got all the big names here too. JP Morgan, Citi, Bank of America, Morgan Stanley, UBS. Goldman's not on here, but close enough. Even some of the niche firms like Cantor Fitzgerald and Craig Hallam are chiming in, all with buy, only outliers. Jay Goldberg from Seaport Global, who went sell, maybe saw something others didn't, or maybe he's just being cautious. And Gil Luria from D.A. Davidson said hold, kind of sitting on the fence. So yeah, bottom line, the street loves Nvidia right now, like really loves it. But you know how it goes. Just because everyone's on one side of the boat doesn't mean it can't tip. Doesn't mean it will, just worth keeping in the back of your head. All this means? The hype isn't just retail or Reddit. This is institutional confidence. But what happens next? That's the real story. Right now, out of 46 analysts, 38 have a strong buy on Nvidia. That's not just bullish, that's like screaming from the rooftops. Add in 2 more buy ratings and you've got 40 people out of 46 saying, we really like what we're seeing. What's even more interesting is how consistent that view has been. 30 days ago, same story, 38 strong buys, 60 and 90 days ago, just one less, 37 strong buys. So yeah, this isn't some short-lived hype. This has been a solid wall of optimism for months now. And check this, 0 sell ratings. Not a single analyst is out there saying, get out. That's rare. The only bear in the room is one strong sell. And honestly, that could be someone just being contrarian for sport. Hold ratings, just a handful, 5 currently. These are your wait and see types, but even they're not negative. They're just not jumping in with both feet. So what does all this tell us? Wall Street's basically saying, this thing's already had a massive run and we still like it. That's a big deal. Usually when a stock runs this hard, you start seeing downgrades, caution, profit taking. But here, the consensus is still strong buy, and it's held up for 3 straight months. Again, not a prediction, not a recommendation, just saying, when you see this kind of agreement from that many analysts, it usually means something big is still playing out. This is a snapshot of analyst updates from August 28, 2025, and what stands out right away is that every single one of them reiterated their existing rating. Nobody changed their mind. That means, despite everything going on in the market, these firms are holding steady on how they see Nvidia. Now look at the target prices. That's where it gets interesting. Most targets are in the $210, $230 range, with a couple just below, like Jefferies at $205, and one going big, Buffett at $235, highest on the list. Even the most conservative target, Jefferies, is still above where Nvidia was trading in early September. So all of these point to some expected upside, at least in the analyst's eyes. And just to be clear, buy means we like it. Outperform means we like it more than the market average. Overweight means we think it should have a heavier weighting in your portfolio. Different words, same vibe, bullish. Also, big names are in here. JP Morgan, Citi, Morgan Stanley, Bank of America, Jefferies, Wolf. This isn't fringe opinions. This is core Wall Street backing. The fact that it's all reiterated, not upgraded or downgraded, tells you something too. These firms already made their bullish calls earlier in the year and now they're just doubling down. No one's chickening out, even after the big run Nvidia's had. So yeah, no fireworks in terms of ratings changes, but a pretty loud and clear message. We still believe in this stock. What happens next? Nobody knows for sure. But this kind of alignment from the street, that doesn't happen by accident. Yeah, alright. So, look at this, man. This is Nvidia's full year financials over the past 5 years, and honestly, it's wild. Like, this is one of those cases where the numbers speak louder than any headline. In 2021, they were doing around $16 billion in sales. Respectable, right? Fast forward to 2025, they're pulling in $130 billion. That's not a growth curve, that's a rocket launch. And what's crazy is they didn't just grow revenue, they grew everything. Gross profit went from 10 billion to almost 98 billion. As that means their margins are holding strong. They're not just selling more, they're making more per dollar. Now check this, operating income. Back in 2021, it was 4.5 billion. This year, over $81 billion. That's nearly a 20x jump. Like, where do you even see that? And this isn't some tiny startup. This is one of the biggest companies in the world. They're also spending way more on R&D, up from 3.9 billion to nearly $13 billion. And that tells you they're not sitting back. They're pouring money into AI, data centers, and whatever's next. Bottom line, net income went from just over 4 billion in 2021 to 72.8 billion now. Even stripping out the one-time stuff, they're still clearing over $72 billion in profit. That's just ridiculous. It's like watching a company morph from big tech to foundational tech. They're not just riding the AI wave, they are the wave. Alright, check this out. Super simple, but super telling. We've got 2 key metrics here. Return on assets, ROA, and return on equity, ROE. Classic profitability markers. They show how well a company turns its resources and shareholders' money into actual profit. Now look at Nvidia. ROA 0.62%, ROE 0.87%. At first glance, these might not look massive. But hang on, let's put them in context. Compare that to the rest of the sector and industry, and it's night and day. Sector average, ROA, is actually negative. 0.02% ROE, 1.26%. Industry, even worse, 0.22% ROA, 2.99% ROE. So what this says is, while a lot of companies in the space are burning money, NVIDIA is not just surviving. It's delivering real return on what it owns and what it's been given. Even compared to the S&P 500, which is cruising at 0.07% ROA and 0.08% ROE, NVIDIA is in a different league. We're talking 8 to 10 times better return on equity than the market average. What does that tell you? This isn't just a hot story. It's an efficient machine. They're not just making big numbers on paper, they're actually turning what they have into real money, while the rest of the industry is basically underwater. So yeah, small percentages on paper, but when everyone else is red, that green stands out real fast. Look, NVIDIA is expensive, no question, but the numbers show why it's expensive, and more importantly, whether that price makes sense. Price at earnings ratio, 49.227. That means investors are paying $49 for every $1 of earnings. That's not cheap, but let's compare it. The sector average is 65.95. The industry average is a whopping 105.42. The S&P 500 average is 29.09. So yeah, NVIDIA is pricey compared to the broader market, but cheaper than its peers, which tells you it's one of the more reasonably valued plays in a high-growth, high-expectation space. Investors are willing to pay a premium, but they're getting something real for it. Price-book ratio, 51:38. This one's wild. You're paying over 51 times the book value. In plain terms, the market doesn't care what's on NVIDIA's balance sheet in terms of physical assets. It's pricing in future potential, IP, dominance in AI chips, and momentum. Now compare. Sector, 3.76. Industry, 1.09. Some companies are underwater. S&P 500, 4.48. The takeaway? Investors don't see NVIDIA as a factory or a hardware company. They see it as a platform, something you can't measure in just assets. Price-revenue ratio, 24.67. You're paying nearly $25 for every dollar of sales. That's huge. But again, sector average, 17.89. Industry, 10.76. S&P 500, 4.58. So what does this tell us? Not only is NVIDIA selling, but the quality of its revenue is top tier. Every dollar of revenue is expected to generate outsized future profit. It's the kind of revenue the market is willing to overpay for. While its price-cash flow ratio, 22.42. This is the multiple of operating cash flow. Basically, how much are you paying for every dollar of real, actual cash the company brings in? Sector, 5.46. Industry, 2.11. S&P 500, 9.21. So again, yes, NVIDIA is trading rich, but it's also throwing off real cash. And that's what keeps this whole thing grounded. This isn't a company running on fumes or hype. There's actual money flowing in. Yeah, it's expensive, but it's not empty-calorie expensive. These multiples show a company the market trusts to continue delivering. You're paying a premium because NVIDIA has earned it. Dominant position, explosive growth, and real profits. So if you're looking at the numbers and wondering if this is a bubble, it doesn't look like one. It looks like a high-performance machine priced like a high-performance machine. Capitalization ratio NVIDIA, 0.71 versus sector, 0.45. Industry, 0.35, S&P 500, 0.34. This tells us how much of NVIDIA's total capital comes from equity versus debt. A higher number means more equity, less leverage. So NVIDIA's at 0.71. That's high. That means they're mostly funded by shareholder equity, not debt. Translation, they're playing it safe. While the rest of the market uses more borrowed money, NVIDIA is sitting on a strong equity base. Debt, total assets, NVIDIA, 0.29 versus sector, 0.55, industry, 0.66, S&P 500, 0.66. Only 29% of NVIDIA's assets are funded with debt. Compare that to 66% across the S&P and tech industry. That's lean. They're not over-leveraged, and in a rising interest rate environment, that's a smart position. They're not dependent on cheap money. Debt, equity. NVIDIA, 0.41 versus sector, 0.9, industry, 2.5, S&P 500, 0.61. Now this one is a bit wild. That 2.5 in the industry average, that's high. It means companies are carrying a lot of debt relative to their equity. Nvidia, on the other hand, sits at 0.41. Again, disciplined. The S&P 500's 0.61. That's likely due to some quirks in the dataset, maybe negative equity or unusual accounting treatment for a few companies. Doesn't change the story though. Nvidia is conservatively financed. Bottom line, Nvidia's capital structure is strong and healthy. They're not betting the farm on borrowed cash like some others in the industry. They're equity heavy, light on debt, and positioned to weather volatility without sweating interest payments. If you're holding Nvidia, this is the kind of balance sheet that lets you sleep at night. Comparison to leading securities in the sector: Nvidia, NVDA, the beast. This company is a monster. Market cap, 4 trillion pluses. That's bigger than Germany's GDP. Revenue, 130 B. Net profit, 72.9 B. Return on equity, a mind-blowing 86.5%, meaning every $1 invested brings back almost $1 in net income. That's wild. Most solid companies are happy with 15-20%. Their EPS, earnings per share, is $3.39, and even with that, the PE ratio is 49.3, high, but the market is pricing in massive future growth. 5-year price change? Pas poignant, 223%. That's crypto-level performance, but from a blue-chip tech stock. Qualcomm, QCOM, the solid veteran market cap around 172 B, net profit of 10.1 B, and return on equity of 42.6%, solid. PE is just 16.4, which is cheap compared to NVDA. It's your classic cash-generating semiconductor company. No AI hype, no insane growth curve, but reliable and probably paying decent dividends. 12-month stock change is 2.4%, so it's been overlooked lately. Could be an opportunity if you believe in a rebound. Blackay, Microchip, MCHP, struggling but interesting market cap, 35B, revenue 4.4B, but net loss 0.5 million. Return on equity is negative and the PE is over 91, high for a company not making money. The stock is down 14.1% over the past year. Market's not feeling it right now. Could be a turnaround play, but risky. Astera Labs, iLab. The hype newcomer. Tiny revenues, 396 meters, and 83 ms in losses, yet a 31.5B market cap. That's a price to revenue of 50x and PE of 360 plus. Insane. But here's the thing. Stock price is up plus 358.6% in the past 12 months, and bar 110% in just the last 3 months. This is a momentum rocket. The market sees something, it may be future AI hardware demand, high risk, high potential reward. Classic story stock, either a unicorn or a bubble. So, what are we looking at? This is a snapshot of insider selling activity. Execs and board members unloading stock, and not small chunks either. This is hundreds of millions of dollars worth of shares. This kind of activity always raises one question. What do they know that we don't? Let's go through it. The big one. Brooke Sewell. 204 manders on SEP3. She dumped 1.2 million shares. She's a director, so she might not be in the day-to-day, but $204 million. That's not trimming your position, that's an exit. That alone would be enough to spook some institutional holders. Jen Sun Huang, CEO. Multiple sales, call 147 mil total. He sold on 4 different dates. SEP3, 38.6 ms, AUG18, 27.1 mem. AUG13, 41.0 ms, AUG8, 40.6, and it's spread out, which tells me it's probably part of a 10B5 to 1 plan. They scheduled sales, maybe for tax or liquidity. But still, the CEO cashing out 147 million in under a month, that's not nothing. He's definitely locking in some gains. Others jumping too. Dawn Hudson, Director, 15.3 M. Deborah Shoquist, EVP Ops, 9.4 MEMS. Colette Kress, CFO, 8.4 MEMS. Stephen C. Neal, Director, 290K, smallest but still a sell. This isn't just one person taking profit. It's a wave of insiders. How I'd read this. This doesn't mean the company's going to crash, but when this many insiders sell at the same time, especially this aggressively, it usually means one of 3 things. 1. They think the stock is overpriced short-term. 2. They expect growth to slow down, even if earnings will still be good. 3. They're just de-risking after a massive run-up. None of that screams, buy the top. Final thought. If I'm long, I'm watching the next earnings call like a hawk. If I'm not in the name yet, I'm probably waiting for a pullback and signs the market digests this selling. Because when the captain and his officers are headed for the lifeboats, I don't want to be the one still dancing on deck. So, Here's my take on the stock, just between us. The company's crushing it. Revenue is off the charts. They're riding the AI wave harder than anyone else, and demand doesn't seem to be slowing down. Honestly, fundamentals are solid, and everyone on the street is talking about them like they're the golden child of this cycle. But here's the part that caught my eye. Insiders, and I mean the very top CEO, CFO, directors, have been selling like crazy over the past few weeks. We're not talking small chunks, we're talking hundreds of millions of dollars worth of shares, and it's not just one person cashing out, it's a wave of sales. Now, I'm not saying that means the stock's going to tank tomorrow. Insider selling doesn't always mean something bad is coming. Sometimes it's just profit taking. But still, when everyone inside the company starts unloading after a massive run-up in price, you've got to pay attention. Also, expectations are sky high right now, like baked in perfection. And when that happens, even a small miss in earnings or a slightly weak forecast can cause a drop. That's just how it works when a stock gets this kind of valuation. Bottom line, it's a killer company, but it's no longer cheap, and insiders clearly think now's a good time to cash out. That doesn't mean the run is over, but it does mean this isn't the early innings anymore. Not investment advice, obviously, just my 2 cents friend to friend.